Welcome to Brave New Edge. Today's guest is Bill Woodruff.
Welcome, Bill. Great to have you with us. So could you give us a high-level introduction to your role as the managing director?
Yeah, happy to. At the highest level, I've built a near 25-year career focused across a variety of wealth management, wealth technology, and more recently, forming capital for the purposes of deploying money into the sub-ecosystem to support AI infrastructure. So broad, deep background across all of those spaces.
Okay, great. What does a typical day or a week look like for someone in your position?
Ooh, typical is tough. A lot of what I've done tilts entrepreneurial, and with that, smaller companies, and the smaller a company, the broader the sets of hats that you have to wear, and I've had to wear. So it starts with standing up very efficient teams built around modern technologies to help build strategic directions and then execute on those in really efficient ways. And so that's the challenge I face every day is, what's the mandate? How do we build the team to go execute efficiently on that mandate, and then try to accomplish a lot with the resources we have and right size that. So a lot of what my day to day looks like is really distilling down and aligning resources and identifying that right opportunity to go execute on that.
So with your expertise in wealth management industry, so where do you see operational bottlenecks, as you said right now? So what is that? Is it like, I don't know, client reporting, communication, regulatory compliance, or lack of proper tools? So what do you see as a bottleneck here?
Yeah, that's such a fun question. I'll just hit that one right on the head. The biggest issue, and it goes downstream across all aspects, is the most of the industry in wealth management well, there's subcategories. And so what I'm about to say is specific to the channel for independent registered investment advisors. But the bulk of the technology that's being built around that is being built around custodians, predominantly Schwab, Fidelity, and Pershing, and their technology. And those custodians have technology that's incredibly antiquated. And so that downstream link to systems and process it creates a massive hurdle and challenge. And tackling competing in that custodial first space is a massive undertaking. To my knowledge, the only organization that's even attempting to bring to market a competitor that's technology first is Altruist. And even there, they've got a lot of work to go to get to the point where that their technology first custodial offering can viably compete with or replace a Schwab, Fidelity, or Pershing. So through that lens, what I'm seeing is in the most innovative places, farther through my role there, being at the forefront of that. It's built the way in which I see innovation and opportunity is still it's inhibited by the being built on top of this less modern infrastructure at the custodial level, but it's okay. We can't change them. How do we build a proprietary portal infused with AI that solves for the various different forward-looking stakeholders. And so it's the how and a lot of this needs to be narrowed. So let's narrow it. So I narrowed it by the independent registered investment advisor. Let's also narrow it by the customer type of an ultra high net worth or high net worth household. And so that then becomes a stakeholder and what's their need and their expectation from a digital experience. Then you have, and this is one I think that gets oftentimes overlooked. You have, when you're managing wealth, there's a massive body of tasks, and those tasks, and so you need to track those tasks, and they span other stakeholders. They span into the client or household and their participants. They span into the other related service providers, say the CPA or the state attorney, and then from a wealth team perspective, there's the investment expert, there's the planners, and so these are all the stakeholders. And so I view the opportunity, and farther again is in my opinion the leader in building this, as designing a proprietary solution via a portal that addresses all of that in a single AI infused, technology rooted solution.
Okay, so I guess that what you're saying is that you actually built some custom solution on top of the existing data, which is, as you said, not that doesn't have a great pipeline that to provide you this in a modern way, but this is how it is. So on what kind of a data you're actually relying? So what are those data that you're using? And are there some other, I would say, non-standard data that you can actually use in your day-to-day business?
Yeah, great question. So let's take a Schwab or Fidelity or Pershing. They have data files, and they've not changed the formats of those data files. They provide typically nightly, not even in real time, through say an open API as an example. And those data files were built, I don't know precisely, let's call it at least 10 years ago, if not 20 years ago, and they're still in the same format. And so a good chunk of the industry will take that, will use a middle layer, a Black Diamond or Orion, to take those data files and then reconcile it into a usable format. And then from there, and Farther's included in this, although optimally over time will remove that middle layer and process. There's line of sight to this, and the use of AI is accelerating the ability to get to this point, having what's growing into a 50+ internal person engineering and development team, augmented and enhanced by AI, is accelerating our abilities at the farther corporate level to get some of this done. For now, there's this reconciliation layer at a Black Diamond or Orion level, and then data can be pulled from that. And that's a cleaner data, but it's also a data that's one layer removed from the source. And as you do that, you add a whole separate solution challenge set. So the optimal, so those are some of the issues or challenges that are faced. Then so the optimal state, as I see it, just from my seat at the table, is taking the data that can be acquired as direct from the source, integrating that or creating a proprietary process and driven through those various different user profile and experiences I described earlier, and serving or solving for and serving for all the different use cases and needs. And so maybe some examples of what that might look like. So right now you have the average advisor platform or program is being built on all these intermediary and outsourced layers to solve for everything. And so I think that's going to get disrupted in very short order. And again, thanks to the having your own dedicated proprietary portal and engineering resources to remove those aspects. And so it's the data that's needed to produce reports and provide information from an investment perspective. It's the data that's needed to help build a tailored wealth plan that considers the complex aspects of a household and then helps identify actionable planning items that cross the different verticals of, say, investing, tax planning, and estate planning, and other ancillary aspects. So right now, the average financial planner or investment advisor in the United States has this layered set of outsourced softwares that are fragmented, and they're in this seat of getting to know their customers manually or by putting inputs into softwares, and then processing these intermediary softwares, and then manually coming up with, here's my recommendation. The future is the disintermediation of all of those component parts driven by a software aggregating this data, synthesizing this data, identifying the actionable planning items, and helping guide a single expert to be able to provide the advice work product to the end high net worth or ultra high net worth household.
That's definitely a good answer to this point. Could you identify one of the data sets out of those that you mentioned that you couldn't live without in this?
Yeah. So when there's multiple, so to categorize the data sets, there's your universe of investment accounts. And that's the clean, simple data set. There's transaction data, there's position data there, and then there's the portfolio accounting that aggregates the risk structure of the portfolio and how it's done over time. Separate from that, there's the data that's needed to understand the dynamics of the client, the household's balance sheet and their income and expense structure and situation, and then driving into that their tax situation. And so all of that data that data universe is what is required to intimately and at an expert level understand the unique household situation and be able to tailor specific financial and or investment advice to optimize their situation. And to define what optimize means in my world, it's optimize for fees, taxes, and risk. And optimizing has a personalized or tailored approach. And an example of that would be, you could have an algorithm spit out, here's what the right amount of risk. Well, there's risk ought to be defined from a tailored perspective, unique to some more qualitative aspects to a client or a household, and should not be, I think, simplified down to the layer of what an algorithm could spit out. So there's some dynamics there. So to tie that back to your question, it's hard. I don't know that one can identify a specific or narrow data set. In order to compete and then do this right, it really requires that holistic, multi-part universe of data, and have that data be as clean and as accurate as possible in order to be able to deliver on what's needed. Uh, and for me, I really have very little interest in the byproducts of what was originally the robo investment advisor world. I mean, that we don't hear that term very often anymore, but that was distilling the asset allocation and advice down to the simplest level of what could be processed from just data alone. And so I think that when it comes to sourcing data, there's very little interest and then in my opinion, value unless you bridge the gap of getting that data holistically across all relevant data points for the complexities of wealth, and then distilling that through and this is I think a relevant, perhaps gapped question of the role of AI, and can AI, there's this period where it's like, oh, robo advisors are going to disrupt investment advisors. And now the next question perhaps is, will AI disrupt investment advisors? And as I see it, the answer to that second question is the same as the answer was to the robo advisor. No, all the data in the world is, and the synthesis of AI is still not enough. It's going to be take that data, design it in a way that allows for the identification of tailored, actionable planning items, and then it's going to still require an expert to bridge, in most use cases, to bridge that gap. So sorry, that was a bit of a deviation from your initial data link question, but hopefully it was insightful and helpful.
Yeah, it's definitely a good point that you mentioned here. So, but when we are on the AI, so let's say we do have right now we do have a clean data, everything is in a data lake, so nice, perfect data sets that you need. So, how does further leverage AI in a day-to-day operations, like portfolio management, client servicing? So what are the tools that you're using right now? Is it like just no, we're using ChatGPT to actually ask him as an assistant, or are there some other tools that you're using right now?
Yeah, that's a great question. And the answer is, where we are now, and then the aspirational goals that we have that are forward-looking and innovative. And what Farther's done incredibly well is identified where things ought to go and understand that we, as an organization, need to disintermediate instead of build around. And so and that's really hard. So disintermediate optimally probably includes the disintermediation of all the way down to Fidelity, Schwab, and Pershing. However, that's a really big undertaking. And so, what we're doing so far, or what we're seeking, is the disintermediation of all of the software layers after that. And so we're not there yet. And so that's where this needs to go, and we're working towards. And so when it comes to how the organization, and then when I say we, I mean we loosely, because my role is less so on the software engineering and the direction of our proprietary capabilities and product, is how to, or leveraging AI is really, one, having an internal engineering and software development activity for the purpose of having our own proprietary portal and disintermediating what will become unnecessary software layers. And so the biggest use today for AI at Farther, or that has, I think, the most potential, is the acceleration of the creation of that portal and the delinking of the chain of layers of other software providers. So the number of engineers that we have and that are needed are, well, there's always a gap there. I mean, even with the scale of FAR, there's a raise of capital, which is well in excess of $100 million. It's still not easy to infinitely deploy a massive team of engineers. That's still a very expensive undertaking. And so it's my observation that the biggest opportunity is to, one, have that proprietary capability, but then at the current stage, AI's biggest impact is the magnification of that team's ability to create the needed software to put this all in one proprietary package and remove those intermediary software layers.
Okay, so what do you think, let's say, looking ahead? So which, let's say, technologies so you think will have the significant impact on the wealth management industry in the next 5 to 10 years beyond what we see today? So is this something that you might foresee here?
Yeah, I think what I just described disrupts the vast majority of the current software ecosystem universe. So the vast majority of today's wealth management universe are and Michael Kitces puts together this really beautiful visual that shows, and I can't remember exactly the number of categories, but let's call it 10 different roughly categories of software. And I believe that what's going to be required and what can be done with AI is a single portal that does it all. And the vast majority of the industry right now is being built around this daisy chain setup of the different softwares that are needed in order to accomplish the same thing. And as long as you say you need 10 different categories of software, financial planning software, portfolio accounting software, et cetera, and those are all separate and third party, you're missing the opportunity for, through an integrated and single and proprietary connected ecosystem, to drive through and do the work that would uncover the actionable planning or wealth tasks driven by AI and through technology. And so it's my belief, and again, Farther is on the cutting edge of getting this done, that single proprietary portal takes all of the other subcategories and makes them obsolete. So wealth management has not had that innovation gap occur, and I think for the first time it's going to become possible and will happen.
And when you're saying about this portal, so how do you see it, let's say, from the user experience perspective? Is it like some sort of a chatbot that actually gives you all of those answers, or is it like some diagrams showing you the portfolio of each of your clients?
Gosh, that's such a good question. The challenge that's a challenge that's probably impossible without AI to get right, and that's why I think what can be built will leapfrog and put into obsolescence the vast majority of the current software ecosystem for wealth management. Sorry, I lost my train of thought. Can you re-ask me that question to get me back on track?
So how do you see you're saying about this portal that will actually combine all of the tools that you're currently using on your day-to-day operations, and how do you actually see it looking like? What is the user experience
right.
there?
What's
Is it like a single chatbot or like some sort of combination of all of those tools?
Yeah, the major problem with user experience design is there are tons of different the way in which advisors and other related professionals operate and provide their services are not all the same. And then the needs for different high net worth and ultra high net worth clients are very, very different. And so having a user interface or user experience design that's not malleable, it doesn't work. And so I don't know. I can't see, my crystal ball doesn't work well enough to speculate for the exact structure of what that looks like. And I don't think it's a chatbot because I mean, it might be for under a certain age category, but above 40 years of age currently, I don't know that there's going to be a place before it's just that, where it's some hybrid of digital user experience in more of a dashboard format, augmented by a chatbot. But what I think the key is in digital user experience is giving the relationship leader, the expert who's providing the tailored wealth management oriented experience through this platform, an ability to customize the end customer's user experience or journey. It will not be a one size fits all. And I don't know, I'm not sure, and I think it's a hybrid between chatbot and dashboard in order for that to be done optimally in the next, say, 10 to 20 years. Looking any further out, that's sort of, it could get kind of sci-fi like beyond that. But I don't think that's super relevant. I think that the optimal path in deploying and building something for the next 10 years is something that's a hybrid between traditional dashboard and AI enhanced chatbot.
Yeah, so that's, I mean, the question was more like in the role of the human financial advisors. So how they should evolve as AI and automation become more prevalent in the industry itself. So that was more related, how will the new financial advisors actually evolve with those tooling? So I guess that this is not the same as we've been working on like 10 years ago. So things definitely changed, and what will be the approach in the future. So how the financial advisors will evolve in order not to be, let's say, destroyed by this new technology.
Yeah, I don't think there's any scenario in the next 10 years where the financial advisor, as it's currently defined, gets destroyed or totally disrupted. And the reason I believe that is I don't think the average customer who hires a wealth manager, their motivations and links to their decision will materially change. I think in the next 5 to 10 years, that will remain a decision that's very linked to the trust of an individual or person. What will change, though, is the ability of that competent person, and let me define competent. It's the crossroads of the ability to articulate and build trust and understand how to solve the problems and the wealth problems. And the wealth problems are diverse. So it's not just, and there's lots of people that can look at a CFA or CFP fact pattern, on a test and say, okay, I know how to optimize for this. That's not enough. You need to be able to bridge that with the ability to articulate that in a way in which you build trust to the end customer. And there's a sales element to that. And so in the next 5 years, 10 years, that's not going to change. That's, in my opinion, that's going to still be what drives most of the industry, is the universe of people who can do that. What will change, though, is the AI-infused tech ecosystem around that person, so that it enhances their ability to provide a better, and when I say better, it's a solution that doesn't miss details because it's driven by a single proprietary data universe that's integrated and driving the solutions, and AI infused, one that doesn't miss details and also is tailored specifically to the uniquenesses of each household. And so that I think is the opportunity. From a technology perspective, I look at it as very little potential to disrupt that person as I define them, who has that ability to bring those two things together. But again, I think it still links back to, as it has for decades, the trust relationship to the expert.
Yeah, that's the great perspective. So I do see this as well, and yeah, this is something that I hear from a lot of people in this area. So as we are, let's say, reaching to the end. So you mentioned that you are following the U.S. semiconductor manufacturing industry. So what do you see, if, let's say, from an investment perspective? What opportunities and risks do you see in this revitalized sector right now?
Yeah, that's so much fun. Thanks for asking about that. I grew up in the industry from a wealth management and fund investing in capital formation from a fund perspective. So spanning, say, running a mutual fund to the whole private markets ecosystem. And so when it comes to AI, I mean, there's this. So first of all, let me maybe define how I think about what's going into investing in AI. I saw recently, and I won't be able to place the source or quote of this, that 50+% of current GDP is somehow linked to CapEx associated with AI. And so the way that I think about and break down the opportunity universe of AI is, at the highest level, there's the pursuit of general artificial intelligence and/or superintelligence. Below that, there's the software infrastructure layer and all aspects of investment that go into that. You might include the pursuit of agentic AI in that layer. Below that, there are three categories of investments in what I would define as physical infrastructure. There's the chip manufacturing, or the creation of the chips that are needed to drive compute. There are the AI factories, which I prefer to use that term over data center, but you could call it data center too, which is where the chips are going into. And then there's all the power systems and that are needed to power all of this. And so as I look at that entire ecosystem, there is a vacuum of capital, and the vacuum of capital has been to AI factory, data center, and up, software infrastructure, and anything that's driving the pursuit of AI, general artificial intelligence, super intelligence, or agentic AI. And I think that a lot of that has been driven by the United States' success on the software side. We're very good at and know how to form capital for and drive software innovation. I think that may and I believe that there's a willingness to invest in those areas at valuations that are at premiums that probably will not monetize relative to those investments, at the detriment of the sub-ecosystems that are on the advanced hardware side, that are really prerequisites to make any of that work. So for example, and some of this is also linked to the practical realities of offshoring manufacturing for decades. So in order, and the criticalities of having secure supply chains in order to get this done, and get this done in the cutting edge or bleeding edge technologies that will be required to maintain our edge. And so restoring the US's hardware manufacturing and related leadership, I think, is the single greatest opportunity from an investor perspective. So and I think there's a vacuum of capital elsewhere that has starved out that category to some degree. And I don't see the same sorts of valuation heights or premiums in that space. Yet, as I view the needed, I view that as a sub pillar for that is required to justify all the rest of the investing. So sorry, that's a lot, and perhaps didn't quite get it tied back to your initial question. So I'll pause and please feel free to narrow or re-ask your question.
Yeah. So what is actually the risk you see in this sector? So what are the most, I would say, obvious risk within
valuation? I think that there's a general. So we've been since March of 2009. The United States has been invincible, really. I mean, we've had a couple minor declines, and they're minor in the 16 plus year, context. And so there are too many investors out there that are willing to invest in the hype around technology linked to AI at any valuation. And then, I continue to hear the longer the cycle goes, the more often I'm hearing valuation doesn't matter. Valuation, in my opinion, always matters. There always, when you put dollars to work as an investor, there has to be a tangible cash flow based link to what will happen with that investment. It can't be built on things that are circular or things that may or may not happen. So one tangible example is my areas of expertise are more on our first part of our conversation. So I'm not going to pretend to, in this example, say, gosh, I have this incredibly robust understanding of this world. But based on my understanding, say the Blackwell chip by NVIDIA has a likely up to 2 to 3 year useful life before it becomes potentially obsolete as it's cutting edge. And so we have this massive CapEx spend to buy these chips that are going to go into these wildly expensive data centers, and then they're going to become obsolete. And so you look at that, the numbers associated with that, it's hard to see the path towards near-term monetization of all those dollars. And to me, it's not to say that that's a bubble with certainty. I hate the idea that I hate those that feel comfortable getting their crystal ball out and concluding those sorts of things, because there is the case of in that near term, those that race towards that with all that massive CapEx do achieve artificial general intelligence or super intelligence, and it does unlock something that justifies all of this. However, the amounts and this is, so let me tie that back to valuation matters. What you pay for that relative to its probability of those cash flows coming into existence matters. And so I have no interest in taking that bet relative to what you're seeing in valuations. And let's say, let me oversimplify this and say, I don't have any interest in owning NVIDIA at $4.5 trillion of value. I think that the positive potential is so built into that value that, to me, that's of zero interest. However, to narrow this to what is of interest from an investment perspective, it's sub areas. Let's say the advanced hardware manufacturing ecosystem that is going to, and that's a incredibly fragmented ecosystem, thanks to us offshoring manufacturing in the United States for decades. Investing into that, which we have to reestablish leadership there. Investing into that, where there is, from my seat at the table, near zero valuation, hype-oriented valuation embedded in that, yet the same sorts of, to the extent we're going to be successful in the pursuit of artificial general intelligence, we need that hardware technology leadership. I view, again, through the valuation lens, investments into advanced hardware oriented manufacturing in the United States as having AI linked upside, but without having to pay valuation premiums like you are in all of the trendy areas of AI. So to me, that's where I'm focused in terms of deploying investment dollars and resources.
So, what role do you believe institutions like Farther can play in supporting the growth and innovation within this US semi ecosystem?
Yeah.
Did you as a supporter here, or it's just like,
I don't think
riding the
so.
wave?
Yeah, I would segregate those two things. So, and I do. So I have, when I am operating under what I'm deploying for AI infrastructure investing specifically, I do that outside of Farther as a disclosed outside business activity that's independent and separate from my activities through Farther. So Farther is, in my opinion, the leader in solving for what AI can do from a software perspective and innovating in wealth management. However, because they're focused on that, it's my internal observation, which I'm only one person of over 500 people at Farther. It's my internal observation and just my opinion, not representing Farther, that Farther needs to stay focused on innovating in wealth technology, and they're doing that and they're executing on that. And it's hard, I think, as an organization that's newer and needs to focus and deliver on that, to also underwrite and deploy capital in forward-looking ways. Because there's the business bet of breaking from how allocators allocate that is hard. And you're not seeing across the board, including Farther, which is again why I segregate my activities away from Farther for when I'm deploying money into AI infrastructure as an investor myself individually. So that brings up a really important topic about why advanced hardware manufacturing is not benefiting from an investment perspective, and it's because of how capital is formed in the United States. It's consolidated into the largest participants. And let's look at private equity as the example. And I don't know, again, off the top of my head, the exact statistics, but I want to call it something like 60% of all of private equity is being formed by like the 10 largest sponsors in the United States. And to me, and so then you have this downstream aggregating effect to this universe and a ecosystem that is very large and becomes sort of a rinse and repeat of here's how we did well yesterday, and an absence of organizations willing to say, okay, here's where the value is, or the counter trend and opportunities. So it starts at the farther like level when it comes to allocators, and then they're not. It's a very challenging thing for them to then allocate money in a way that's different from the largest private equity, because that's the safest way to do it. And then the largest private equity organizations have their, here's what we do, rinse and repeat. We can only do these sorts of things. And so there's a real problem with how deals are sourced and how opportunities are underwritten. And while it feels really good while everything's working, I think it contributes to the boom and then bust ecosystem of the global economy. And so I don't want to suggest I have any insights into whether a bubble might be forming, but I'm totally uncomfortable as an investor individually, just simply relying on that generic capital formation process that gets implemented in the United States.
That's really interesting angle. I did see it from this perspective. So yeah, I guess we are nearing to the end. So what is, let's say, one of the key takeaway you hope listeners will gain from our conversation today regarding this intersection of finance, technology, and the future trends?
Yeah, I think that it's an incredibly difficult space to be in as an investor. I think that being willing to depart from the status quo right now, or the things that have done well recently, is probably more important than ever before. And so whether that's, and I think there's been this, it's been too easy to go out and invest money without having to diligence and underwrite value. And I think that those that intentionally can diligence and underwrite the value and the future probable cash flows, there'll be a massive difference between those that do that and those that continue to do what's done well yesterday.
That's a great closing statement. So thank you so much for being with us today. So it was quite helpful, and yeah, let's hope we'll hear again in the future to see and to actually validate what we talked today.
My pleasure, and thanks so much for hosting me, and really appreciate your questions.